Okay, there is coming in. All right, so hello everyone. Welcome to the 10th class. Uh, been going strong, and yesterday class and today class, we're talking about a couple, MLO activities and such, touch base with the different program, loan programs and all that, traditional, non-traditional, conforming, non-conforming. Okay, so just kind of see the difference between each program. Okay, so we are at the 10th class. Awesome, class number 10. Okay, nothing changed here. Okay, so we were talking about qualified mortgage and non-qualified mortgage, right? And there's some of the most common loan categories are conforming and non-conforming loan programs. When we're talking about conforming and non-conforming, it's meaning that okay, does this program meet the Freddie Mae and Fannie Mac? I know Fannie Mae and Freddie Mac guidelines and standards. Okay, if the loan program meet their criteria, the requirements, then the loan is conforming. Okay, if they don't meet, these two, entities requirements, then they are non-conforming programs. Okay, and also you have conventional or non-conventional. Okay, traditional or non-traditional. Okay, conventional is like kind of conforming. Okay, non-conventional meaning that it's past the limit, the loan limit of the of the loan guideline, loan amount for each particular zip code. Okay, so anything that past that is a non-conventional. Traditional loan or non-traditional loan. Traditional loan are the one that meet with the guideline. Okay, and the non-traditional one is the one that doesn't meet the guideline. Okay, or like government loan. Okay. So I see that a couple more people, trickling in. Let me drop the file one more time, okay? Sorry about that. Okay, so I just dropped the file again. Okay, so today we're gonna talking about QM, non-QM, as well as conforming and non-conforming. So QM is any loan that satisfy the guidelines of Fannie Mae and Freddie Mac. So we call them qualified mortgage, right? The one that doesn't meet, we call non-qualified mortgage. And now we're gonna talking about conforming and non-conforming loans, right? A conforming loan is a type of mortgage that the types of mortgage loan that meet the guidelines and lending criteria established by the Fannie Mae and Freddie Mac, which are the two government sponsor entities, TSEs. Okay, make sure you remember this acronym, TSEs. Okay, which is a two government sponsor entities. There only actually there are, I believe, three government agencies, which is another one is called Jenny Mae. Okay, and that is a lot of that is for insure the government loans. Okay, so Fannie Mae and Freddie Mac are the two government sponsor and enterprises in the U.S. These guidelines include the limit on the loan amount, borrower credit worthiness, like what is the score, any debt, any outstanding late payment and things like that. Okay, and also the loan to value ratio. Okay, conforming loans are popular because they typically offer more favorable interest rates and terms compared to the non-conforming or jumbo loans. Okay, jumbo loan we call non-conforming loan. Okay, and so any loan that meet these criteria will have pretty good rate, because guess what? The reason is that any bank, lender, private bank, institutional banks, right? When they issue the conforming loan, they are guaranteed that these loans can be sold in the secondary market, which is going to be purchased by Fannie Mae or Freddie Mac. Okay, so that's why they need to be conformed. right? When the loans are conformed, these is a guarantee that these entities, the GSE will buy that loan. Okay, because like I mentioned yesterday, that when the bank lend out, they actually tied up their equity. They actually tied up their fund. They actually tied up their money, right? So regardless how much money they have, let's say they have $2 billion. Eventually, if they lend out to millions of people, right, that money will be empty at one point. So and every loan that they initiate, right, they will collect a fee on it from the borrower. So when you're talking about couple million loans, and let's say 2% fee, maybe let's say $6,000, right? A couple million could be $6 million, right, or $12 million, whatever that number is. Okay, and then they need to sell that loan to Fannie Mae and Freddie Mac, and they don't pay fee for the government sponsor enterprises, right? And then Fannie Mae and Freddie Mac actually making money by collect the interest. Okay, so they keep for a long time. They can keep it for 10, 15, 20, 30 years, or whenever the borrower refinance or pay it off. Okay, and then when these agencies that bought these loans, they pay the money back to the bank, and the bank has more money to go out and lend and collect fees. Okay, so that is how the whole cycle is working. That we start out with the primary market, represented by bank and private investors. Okay, and then that loan eventually sell to the GSEs, and then they get the money and they we do the process. Okay, that is conforming loan, right? Meet the guidelines. What about the non-conforming loan? Non-conforming loan, also known as a jumbo loan. Jumbo loan, when you're talking about jumbo, meaning it's big, okay, big loan, or the loan that passed the limit that's set by the Fannie Mae or Freddie Mac. Okay, so jumbo loan is a type of mortgage that does not conform to the guidelines and lending criteria established by the GSEs, right? These loans are typically used to finance a high-value homes. Okay, for example, if the conforming limit is 750, okay, but you buy a $1.5 million home, right? Of course, you actually in the jumbo area, right? Whether you pay your down payment 20%, it's still over the amount, right? If you buy a $1.5 million dollars home, you down 20%, meaning you down 300,000. So you need a loan of 1.2 million. The conforming limit is 750. Now you obviously you see there's some difference right there at $450,000, right? Or $550,000. But that's saying that you need additional money. So meaning you need a bigger loan. That bigger loan is called jumbo loan. Okay, these loans are typically used for like I say, high value home that exceed the conforming loan limits set by the Federal Housing Financial Agency. Okay, the conforming loan limit set by the FHFA, right? FHFA set the limit depending on the zip code, city, I believe, right? So depending on on those area, right? Let's say Beverly Hills, they may have the loan up to 1.1, for example. Escondido, they may have a loan up to maybe 725 now, right? Or let's say Carlsbad, San Diego, right? The loan maybe go up to A75. Okay, so the FHFA is the agency that's set the loan limits, and they evaluate that every year, right? And sometimes they take into account of the economy as well as the the inflation. Okay, so non-conforming loans are considered riskier for lenders, and often come with stricter lending standard and higher interest rates. So when you get a jumbo loan, you may pay a little bit more on the rate, right? And the guideline may be stricter. However, There's an opposite to this. If you get a jumbo loan with a bank, let's say a Bank of America, okay, sometimes you get a better rate with that bank, okay, if you do banking with them. Sometimes they give you like a half a point if you are a platinum member, and if you do the direct deposit, they give you a quarter, an eighth of a point, like a 0.125, right? And you know, if you move a couple $100,000 into their Merrill Lynch broker account or trading account, they give you another half point. Okay, and if you after you close the escrow and you bring in another couple $100,000 into Bank of America, they're going to give you another half point, for example. So due to that, right, the rate for jumbo loan with like big banks like Bank of America, gonna be lower. Okay. Now we're talking about traditional, which is conventional, or non-traditional, which is non-conventional loan programs. Traditional loan program, also known as conventional loans, the category of mortgage loan that are not insured by FHA, VA, or USDA. So when we talk about traditional loan, right, we're gonna exclude FHA, VA, and USDA. Okay, because these are like have lower interest rate and all that. It doesn't meet the guideline. Okay, traditional loans are originated and funded by private lenders such as banks, credit union, mortgage company, without government backing. Okay, I'm talking about government backing. I mean like U.S. government backing. Okay, any agency belong to the government. Okay, because banks, most of them are actually private banks. Okay, and the one that I say, insured by the government or the VA, FHA, and USDA. Okay, non-traditional loan programs, also known as alternative or non-conventional loan programs. Okay, which are the mortgage option that differ from the standard conventional loans offered by private lenders, which is banks, and government-backed loans. Okay, government-backed loan is another set of loans, right? Private lender give you the conventional conforming loan, right? Now you have the third one, which is a non-traditional loan. Okay, the non-traditional loan are the one that provide financial solution for borrowers who may not need or the strict requirement of the traditional loans. Okay, so traditional loan are the one that get a W-2, get a good income, get a stable income, and all that. So they meet the criteria, right? But there are business owners, there are gig economy, workers, right? Their seasonal income, right? Those are not stable, right? So they need a way to be able to get a loan to purchase a house. So the non-traditional loan program are the one for them, which are the non-QM loans. Okay. Non-traditional loan program may include the following options: FHA loans, VA loans, USDA loans. Okay, which is a non-traditional because like they don't meet the criteria of the Fannie Mae and Freddie Mac, right? FHA loan, a government-backed program, they are considered a non-traditional in the sense that they have more flexible qualification requirements. They don't have to be 20% down. Okay, they don't have to be 700 or 670 credit score or higher, right? They can be low credit score as well, 500, low 600. Okay, FHA loans are popular among first-time home buyers, and those with lower credit score are limited down payment funds. With FHA, you can down 3.5%. Okay, VA loans, Department of Veteran Affairs loan. This is for military personnel, okay, or people with the VA status. Okay, VA loans are designed for eligible veterans, active duty service members, member of National Guards and Reserves. They offer favorable terms such as no down payment requirement. So if you are a VA, you have the VA status, right? You can buy a house with no need to have any money for down payment, but you need money for closing the cost. Or sometimes they even roll that closing cost into the loan as well. Okay. and competitive interest rate, right? With the VA loan, you get the better interest rate. VA loans are considered a non-traditional because they cater to a specific group of borrowers and have a unique eligibility criteria, meaning that you need to have a VA status. A little bit more about the VA loan that I don't mention anything in here. Let's say if you're a military personnel, right? You have a VA status. VA status sometimes meaning that you can be an active duty. You can also be like a retired military, and you get a VA status for life. Okay. So with the VA loan, they dedicated to you an amount, let's say $1.5 million. Okay, that is your maximum amount. That's just a number that I throw out because I know some of my client has a 1.5 limit. Okay, so if you have a 1.5, I don't know the exact number now. Maybe they increased a little bit more. But let's say if you have a $1.5 million limit, right? And your income is qualified to borrow money from that maximum amount to buy a property using VA status. So let's say you buy a home for $800,000. Okay, you have a limit of 1.5. That's good, right? You go out, you buy a home at $800,000 using VA. You can get 0 down. You can do a 5% down. You can do 20% down. However you want it to do. If you have money, you want to put in there, good. Okay, so now you purchase this home for $800,000. So meaning that your limit in the VA, loan is that still have another $700,000. So meaning that you can, after you stay there for a couple months or a year, right? You rent out that place, and then you buy another property. Okay, let's say this time you buy a property at $900,000, but you only get $700,000 left in the VA, right? And you qualify to borrow that $700,000 because of your income, or also maybe because your rental income from the first property is qualified to borrow another $700,000. But now you have to come in with a $200,000 difference for down payment. Okay, or you have to pick a house that $700 or $750, and you down $50,000, or you down $0, for $700. Okay, so that's the idea. And now if you purchase the second VA home using VA loan, now you max out your limit of $1.5 million. Okay, and if you want to go buy more houses, then you either go with traditional loan, conforming loan, conventional loan, or the non-QM loan. Okay, but you cannot use the VA loan anymore because you already maxed it out. Or you can sell one of the property, reclaim that amount, and then go buy another property. Okay, so that's how VA works. Okay, but the VA have several requirements that I will go over, in the later slide. But guess what? Both FHA and VA loan have one option that I don't mention on here, which is a consumable loan. These are consumable loans, especially the VA loan. It's consumable loan. What does it mean by consumable loan, right? Consumable loan meaning that if Mr. John got this loan from VA, right, he can sell this loan to anybody. I mean, he can sell his house to anybody, okay? And that anybody can assume his loan at whatever term and rate that he had signed up for. That is the big plus. So meaning that anybody out there, right? If you want like a really super low rate that that a lot of people got in 2021, right? You're looking for a home that has a VA assumable loan. Okay, most of the VA are assumable. Okay, so meaning that Mr. John want to sell his home. Originally he borrowed $700,000, right? After 2 years, he paid it down to $620. Okay, so he still owes $620, right? Mr. Fred coming in, buy Mr. John home, and also assume his VA loan. So now Mr. Fred able to get a loan for $620,000, right, at the 2.7% instead of 6% right now, right? And then he just only pay on that $620. But let's say if the home is sell for $900, Now he have to come in with cash to pay up that difference. 900 subtract 620. So that's $280,000. He have to come in with that enough money to pay for that part. So that part gonna give it to Mr. John. And then he assumed the loan, beautiful rate loan, right, from VA lender. Okay, so that's how it works. And it works the same thing with the FHA too. Okay, so keep that in mind. Assumable VA loan. Okay, and if you want to go out there and you want to buy a home, right, you can shop for that. You can search on on the MLS or anywhere for the home that have the VA loan. And guess what? If Mr. Fred assume Mr. John VA loan, right, meaning Mr. Fred gonna keep that $620,000, right, until he pay it off. So meaning Mr. John get 1.5 million, have to subtract 620,000, right? And whatever left over, he can use that money to go borrow money and buy a different home. Or until Mr. Fred pay off the entire, pay it lower. The more he pay, the more available, fund for Mr. John. Okay, so hopefully that thing is clear. Okay, so that's VA loan. USDA loans are loans that given out to borrower who live in the rural or eligible suburban areas. Okay, these are often known as no down payment option. Similarly, USDA loan, you don't have to down, but you can if you want to, and also have competitive interest rate. Similar to VA loan, USDA loans are non-traditional because there's specific eligibility requirements and focus on rural housing. And I think like USDA loan is also funding the farming too. Maybe in the next few classes, let me see if there's a different loan for farmers. Okay, jumbo loans, we talk about that, right? Non-qualified mortgage, a non-QM loan. Non-QM loans are category mortgages that do not meet criteria for qualified mortgage. So that's why they call non-QM, as defined by the Consumer Financial Protection Bureau. Okay, they are often used by borrowers who have unique financial situations, such as self-employed individuals, investors, investor with multiple properties, or those with irregular income sources, right? Gig economy, for example. Non-QM loans may have more flexible underwriting criteria, but often come with higher interest rate. Flexible criteria meaning that you just only need to show like 12 months, bank statement. You don't have to show, W-2. You don't have to show 1099. Just bank statement should be enough. Okay. Portfolio loans. Portfolio loans are offered by some lenders who retain the loans on their own books rather than selling them in the secondary mortgage market. These loans may have more flexible terms and underwriting criteria because the lender makes its own lending option. So this is the one that I mentioned earlier regarding to the Bank of America. It's called portfolio loan, okay? And it's also a jumbo loan. And guess what? Sometimes it's a super jumbo loan too, right? Jumbo loan may be above the limit, but maximum at, let's say, 1.2 million. Super jumbo loan is like 1.2 million and plus, right? So that's how they categorize as, either jumbo, super jumbo, or conforming. Okay, assets-based loan. Assets-based loan are mortgage loan where the borrower's assets such as investment portfolio or liquid assets serve as collateral for a loan. These loans are often used by high net worth individuals who may not meet traditional income credit requirements. Okay, so let's say if somebody own a business, right, and what they want to borrow, or they may own a land or whatever, right? They can go out and say, hey, I want to borrow a loan to buy a house, right? I don't have enough income or credit or whatever. Okay, so but I have assets. Okay, I want to collateralize my my asset to borrow money to buy a home. So that's what it is. Interest only loan. Interest only loan means loan that you only pay interest. Okay, but usually you can pay interest for a certain period of time, 5 years, 7 years, 10 years, and then after that period, reach, right, you're gonna have to start paying both interest and principal. But look at this. If you paying interest only, let's say 2,000, right? And by the time you reach the anniversary, 5 years, and that's when you have to pay also interest and principal. But now you pay the same thing, 2,000, right? But your payment is increasing to 3,000, so you are 1,000 less, right? That's gonna make the loan negative amortization, meaning that your loan will keep increasing. So you have to pay, at least the full amount, interest and principal, so that you're gonna pay down your loan. Okay, but anyway, interest only loan are the loan that you pay only interest at certain years, and then after that you have to stop paying principal as well. Okay, the responsibility for Fannie Mae and Freddie Mac. A conventional conforming mortgage is a loan that conforms to established guidelines for the size of the loan and your financial situation. Conventional loan may feature lower interest rate than the jumbo loan, FHA loan, or VA loan. Okay, remember that conventional loan will have lower interest rate than jumbo loan, FHA loan, VA loan. Okay, term for these conventional loans typically between 10 and 30 years, 10, 15, 20, 25, 30 years, right? And are the minimum amount loans that Fannie Mae and Freddie Mac allow. Okay, that's a minimum. Okay, I mistyped that. Okay, so meaning that there is the maximum amount of loan that you can borrow. Okay, conforming, most common loan type. Okay, loan amount must be 647 200 or less. Okay, this number here, I believe I got it like from maybe 2019, 2020. Now this number can go up. It could be 725, or even some area could be 830, for example, right? Or less in most county, and maybe as high as 970. Okay, let's say Beverly Hills, Malibu, for example, right? Their loan limit can be higher. Okay, and you down at least 20%. But if you down less than 20%, then you have to pay mortgage insurance. Okay, conforming jumbo, it's conforming loan, but it's a jumbo, meaning it's higher than the limit. Let's say if the limit is 147,200, then it's higher than that. It's called conforming jumbo. Okay, only available in certain counties. Maximum loan amount varies by the county. Okay, I say earlier, I think I said by zip code or city, then that's not right. So it's by the county. Okay. Okay. Limit on closing cost concession. What is concession? What's closing cost? Okay. Closing costs are all the fees and costs that you pay during the escrow, which could be, appraisal fee, lender fees, loan fees, and all that. It's add up. It's called closing costs. Okay. But here it say the limit for closing cost concession, meaning that the seller can credit, the borrower a certain amount. The lender as well as the realtor can also credit to the borrower as well, but the total cannot reach a certain amount. Majority of the time is 3%. So let's say if you borrow $1 million loan, then the closing cost concession limit is $30,000. Okay, but okay, saying there's some cases that depending on the loan, the concession percentage could be different too. Okay, what are seller concessions? Okay, seller's concession is an arrangement where home seller agrees to pay some or all of the buyer closing costs. Seller concession happen when the seller is having trouble moving their house or selling their house. As an incentive for the buyers, they will agree to kick back part of the purchase price to help the buyer cover the closing costs. So we heard about the term kickback, right? And kickback is not allowed when we give money to a non-licensed. But in this case, this is the buyer and the seller. The seller give back the money, credit back the money, or kick back some money to help the borrowers, to help the buyers to pay some expenses for the transaction. So that's kickback is allowed. Okay, a seller concession can also be initiated by a buyer who needs help with their closing costs. They can upfront say, "Hey, I need you to help me, do a buy down point." That part of the negotiation, right? If the seller want to sell the house, right? It's been on the market for 4 weeks now. They want to sell. Say, okay, I'll help you with the binding down the points. Or I'm helping you, pay some of your closing costs, right? Or pay your entire closing costs. Okay, so that way, they sell. Otherwise, their house gonna stay on the market longer. Right now in this market, I do see that happen. Quite a few, and I see that because depending on the area, right? Some area they have a hard time to sell, probably because they raise the price so high. Okay, and some area they, every home come out, everybody is trying to get it, and then it's causing the price to going up, right? Or overpay sometimes. If the seller doesn't want to lose money on their sale, they might agree to slightly higher the purchase price and then use those extra funds toward the buy closing cost. This is a strategy right now, right here, right? So let's say that the seller intention was selling this home for $750. The buyer coming in and say, "Hey, I'll buy your home, but I don't have enough money to pay for the closing costs," right? How about I'll buy your home for $770. You give me $20,000 back for my credit. Okay, so that I use that money to pay for some closing costs. Any extra, I put in my pocket. Okay, it's allowed. Okay, but guess what? The maximum for that amount is 3% in some cases. Okay. This effectively means that the buyer is rolling their closing costs into their mortgage instead of paying them at the closing table, right? So meaning, they get the $20,000, but that $20,000 eventually roll into the mortgage, roll into the loan, right? So the loan going to be higher, 20,000 higher, right? But guess what? Meaning that if they have, 20,000 on the side, right, they can keep it. Instead of put that 20,000 into this and pay for the closing costs, they can keep that, to buy furniture and stuff after closing the home. That is one way, one strategy that buyer can use. Okay, and you can as an MLO, as a realtor, you can also show your buyer that way. Okay, sometimes a seller concession will cover all a buyer upfront cost. Other time it will not. Some of the concession is like max out, right? And any money that 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 extra you can put in lower the purchase price. Okay, that can be done too. In no circumstances, however, may the amount of the seller concession exceed the amount of the closing cost charged to the buyer, right? The buyer cannot use seller concession to get cash back at closing. Okay, they say this, but the way that the cash back, meaning that, hey, if you put in the 3% deposit, you can get some of that money back because the seller concession fill in that EMD for you, right? So yes, you do have cash back, but you cash back of your money that you put in for deposit. Okay, you don't get cash back for the seller concession money. Okay, the money, the credit that the seller give back. Okay, so think that carefully. Nor can seller concession be used for down payment, home repairs, new appliances, or for any other purpose than to pay for closing costs only. Okay, which is shown on the final CD, closing disclosure. So this is gonna be a little bit clearer on this slide. What do seller concession cover, right? Loan origination fee, home inspection and appraisal fee, mortgage point, right? Down point, discount point, buy down point, upfront mortgage insurance, FHA loans. Some FHA loans that you have to pay your mortgage insurance, but you can using seller concession to pay some of it or all of it if it's not much. Okay, upfront funding fee for VA. Okay, VA and USDA require some funding fee upfront, and you can use seller concession to pay for that, or you have to put money out of your pocket to pay for it. closing attorney fee, prepaid property taxes. Let's say if you buy a home, usually property tax are between July 1st to June 29 each year, right? You pay the first property tax for the first 6 months on December 10. The next 6 months is April 10. Okay, so if you buy the house in any part of it, okay, then you may have to pay the prorate, right? Any leftover. So you can use the seller concession to cover for some of the property tax, payment as well. Title insurance, right? As a borrower, you have to buy a title insurance for the lender, right? The seller will buy title insurance for the borrower or for the buyer, okay? Claiming if any wrong with the title, right? The insurance will pay for it and the buyer get the money back, okay? Cases like, in a home, there's a title of husband and wife, but there's a will, a hidden will, right? Nobody know about it, right? The home got sold, the will come out, and then that person on the will say, hey, I entitled to this property. And then he able to get the property back, right? When he get the property back, and now the title insurance will pay for all the damages, all the monies that the buyer put out, and the buyer get their money back through the title company or title insurance, because the title insurance company couldn't find out about that will. Okay. Also, seller concession can be used for recording fees. So here are some of the maximum seller concession. Okay, so if you have a down payment up to 10%, then the seller concession is 3%. Okay, if you down payment between 10% to 25%, then seller concession is 6%. If your down payment more than 25%, then seller concession maximum at 9%. Okay, so you see that the difference right there, right? Depending on your down payment, the seller concession is changed. The seller concession may not exceed the buyer closing cost, even though it say 3%, 6%, 9%. Okay, but the maximum, the range is the total amount of money you pay for closing costs, right? So let's say if this number apply for $1 million home, a $1 million loan, that's like $90,000, right? But your closing cost only $8,000. So these numbers are actually work well with like property at a lower price. Okay, so the closing cost may be still high, but with this kind of concession, they can cover some or most of the closing cost, but it doesn't fit well with the higher loan amount. Okay, so the higher loan amount, the maximum is the total closing cost. Okay, hopefully you understand that. Okay, there's no cashback allowed with the seller concession. The adjusted sales price, including the concession, need to be supported by the home appraisal. If the appraisal is too low, the seller concession may be rejected. Okay, so meaning that when the lender send out an appraiser gonna appraise the home value and give an amount, right? The price for that home, right? So if that home is lower, right, meaning your loan is going to be lower, and then the concession going to be lower as well. Okay, and sometimes if the appraisal is too low, because the thing is that when the appraisal is low, either the seller gonna reduce the price, or the buyer has to come in with the different money to cover for the difference. Okay, let's say the home offer at 700,000, but the appraisal came in at 650, so they have 50,000 gap, right? Either the seller gonna reduce that. This is the negotiation part. The seller can reduce the whole amount 50,000 and sell at 650, or the seller say no, I'll reduce 25,000. You come in 25,000. Then the buyer have to find 25,000 to come in. Okay, and also some of the money left over by the seller concession might be used for that gap, right? But still, everything needs to be, within the closing cost. Okay, the VA loans, the seller concession may be allowed to exceed 7%, 4% limit. Okay, in certain closing costs are not covered by that rule. The USDA loan, the seller concession can be 6%. So these are the number that you need to know. If in the question it's asked, what is the VA loan seller concession maximum? You say 4%. What is the USDA loan concession maximum? You say 6%. Okay, or if you have a 10% up to 10% down, what is the maximum seller concession? 3%. If you have 25% down, up to 25% down, what's your maximum seller concession? 9%. So far, I repeat the seller concession so many times. It's the money, the credit that the seller give back to the buyer. Okay, continue. Fee charges on loan with certain risk characteristics. Okay, temporary fixed interest rate buy down. Okay, what does it mean? Temporary and fixed interest rate buy down. Okay, so temporary meaning that, let's say you have an interest rate of 7%. Okay, you can temporarily buy down that rate for 1 or 2 years. Usually they call 2-1 buy down. 2-1 buy down means you're gonna buy down for 2 years in total, and it's gonna change for each year. Okay, so if you buy a 2-1 one is a 1%. Okay, 2-1 buy down is 2 years at 1% each year. So meaning for 7% rate, right? The first year, right, your rate is 5% because you start out at 2%. And the second year, you're gonna pay 6%, which is a reduce of 1%. And from the third year and on, or after 2 years, you're gonna pay 7%. So for 7% term, right? First year, you pay 5%. Second year, you pay 6%. And then after second year, it's going to be 7% and on. Okay, so that is what is meant by temporarily, buy down, right? You can also buy down for a fixed interest rate as well. So let's say, you get a rate at 6.5, but you say, hey, I like 6.375. Okay, to get you from 6.5 to 6.375 fixed rate, it's not going to change for 30 years, right? And it's going to cost you $9,000 to bind that down. Okay, the seller say, hey, buy my home. I cannot sell my home. Come buy my home. Okay, I give you $9,000 to cover for your buy down. Okay, so you get that buy down, you pay to the lender. The lender agreed to reduce your 6.5% to 6.375%. That's what it's meant by rate buy down. Okay, a discount point is a type of buy down to lower the interest rate. Permanent buy down, referred to as a discount point, that is prepaid for a lower interest rate. So you prepay some money to get a low interest rate, lower interest rate. Temporary buy down is a 2-1 buy down, first year 2%, lower than the note rate or the rate. The second year is 1% lower than the note rate. The third year, subsequent years, at the note rate or at the rate or at the interest rate. Graduated payment. Payment increase over time as income is improving. So that is one option that you can that you can work with the lender too, right? You can set up that, okay, if I know that my income going to increase over years, right? This year I got $110,000 income, but based on my employer, next year I got 10% raise. Another year I got another 10% raise. So I can work with the lender, say, okay, I want to increase my payment that help to to pay into the principal faster. Okay, borrower will pay PMI if LTV is greater than 80%. Loan to value. LTV is loan to value. PMI is a private mortgage insurance. Okay, and you remember there's a law say that if your loan to value or your equity is going up so fast and it's past the the loan to value of 80%, meaning it's lower than the 80%. Mean now it's 78%, right? It's automatically cancel the PMI, right? We talked about this, right? Or if it's at 80% loan to value, you call in to the servicer, hey, business servicer, please cancel my PMI, right? So depending on the appreciation of the market, right? If you happen to pay PMI and then the market appreciates so fast, you need to aware of that because the bank not going to let you know, right? And the bank may have automated system, right? And sometimes they evaluate the home value, and then when they see that it's 22% or more that you already pay in, or the appreciated value is already going up, they will cut your PMI, stop the PMI. Okay. Fannie Mae, Freddie Mac's automated underwriting system. Because when we're talking a lot of guidelines, we are talking about process and all that, right? This is time consuming, right? So Fannie Mae and Freddie Mac, they come out with some system tools that's gonna help with automated underwriting. In some cases, okay, but most of the case you need an underwriter to look at all the paperwork, okay. Then an automated underwriting system is just a helper, right? It can quickly scan, see if this person is qualifying for the loan, right? If everything looks good, they give an approval letter, right? Easily an approval letter. But if it's not, then maybe the loan officer need to take a close look at it, or the underwriter have to take a close look at it. Automated underwriting engines can provide a near instantaneous loan approval or denial decision based on the information submitted to the system. The most frequently used is called AUS, Automated Underwriting System. Okay, this program in the U.S., the AUS program in the U.S. mortgage industry include, for the Fannie Mae, it's called Desktop Underwriter, or short for DU. Right, any loan that go through Fannie Mae can be used, Desktop Underwriter or DU. Sometimes that as a realtor, right, I can ask the loan officer and say, hey, can you see if this borrower get the DU, pre-approval letter? There's several ways of getting the letters. You can get a pre-qualification letter, meaning that verbally you tell the loan officer some information, so you can pre-qualify, okay? And you can get a pre-qualified letter, and you can use that and send it to the listing agent. Listing agent say, no, I don't like pre-qualification letter. I want a pre-approval letter. Okay, then you need to submit the pre-approval letter, right? Pre-approval letter is the most common used letter to send over to the seller or the listing agent, right? And the best one is a DU, because the DU requires a thorough look at the financial situation of the borrower, and then send out a DU letter or the desktop underwriter approval letter. And then listing agent see the DU, oh, I like it. I like this buyer, because it's gonna move everything faster. Okay, and it's almost like over 90% that this borrower will not fail the loan when they got the DU letter. Okay, Federal National Mortgage Association, called FNMA, is also known as Fannie Mae. Okay, short for Fannie Mae. Fannie Mae's mission is to create a minimum lending standards and liquidity in the mortgage lending community by buying mortgage-backed security in the secondary market to free up capital for lenders to then turn around and lend that money again. Okay, that's what FNMA is, Federal National Mortgage Association, which is also known as Fannie Mae, to create a consistency in the quality of home mortgages. Fannie Mae has developed a set of underwriting guidelines that guide lenders on how to best accept risk, so that the opportunity for default is reduced to a predictable level. Okay, so they have some system, they have some guidelines that are going to help with assess the risk. Freddie Mac The underwriter, the automated underwriter is named as Loan Product Advisor, LPA, Loan Product Advisor, similar to the DU, but this is called LPA. The Federal Home Mortgage Loan Corporation, short for Freddie Mac, okay, offer an alternative to Fannie Mae automated underwriting system, which is the US is called Loan Product Advisor, or LPA, since 2016. This LPA previously was known as LP, or loan processor. Okay, so these two entities have their own desktop underwriter, automated system for underwrite or pre-approve or approve or deny a loan application. Okay. Similar to Fannie Mae DU, Freddie Mac LP is an algorithm-based automated underwriting system with minor differences in the way the risk is analyzed and assessed. Okay, they just algorithm, how they calculate the risk. Okay, underwriting documentation requirements. Okay, in order for DU, for this automatic system to be able to run, these information need to be provided: name, birth date, social security number, 2-year residence history, 2-year employment history, 2-year income documentation, including W-2 or tax return, pay stubs covering the last 30 days, right, for all borrowers. When I say 30 days, usually you're gonna get 2 pay stubs because you get paid by weekly. But if you could get paid by monthly, bi-weekly. If you get paid by weekly, you can provide 4 different pay stubs. Or if you get paid by monthly, right, you're gonna get 1 pay stub. Asset statement covering the last 60 days, okay, which is 2 bank statements. Asset statement meaning bank statement, right? 2 bank statements, 60 days. Source of all funds needed to close, including assets, assistance, gift, and credit. Credit is from seller concession, credit from realtor, credit from lenders, gift or gift letter, okay? And also eventually you're gonna get that money from whoever give as gift to the borrower, okay? So meaning the borrower can have mom, dad, sister, uncle, son, daughter, whoever to give, the money to, to purchase, to put in as down, cover the closing costs, and then, use that money in the escrow transaction. Okay. Okay. Qualifying mortgage program requirements, including when purchasing a non-owner occupied rental property. Okay. So when you buy a home as a non-owner occupied, meaning that you buying an investment property, then seller concession can only top at 2%, not 3%, not 6%, not 4%, but 2%, right? But the thing is that it needs to be some program require a minimum down payment of 25 to 30%. But nowadays, I'm looking for investment property right now, and I can get 15% down too. So due to competition, like lenders, they lower this guideline, and because they lower this guideline, meaning that they are non-conforming, right? They are non-QM loan, not QM loan, not qualified mortgage loan. They are non-qualified mortgage loan, okay? And usually they have a higher interest rate. Acceptable down payment amount, including conventional, you can down like 3%, 97 loan to value. Fannie Mae Home Ready program, 3% down. Freddie Mac Home Possible, 3% down. These are the loan programs. Okay, conventional loan with PMI 5% to 19.99 down with the PMI. Piggyback loan, no PMI, 10% down. Okay, we're going to talk about these different loans in the subsequent classes. Conventional loan with no PMI, 20% down. Okay, it's a conventional, 20% down minimum. Requires some hazard insurance, right? Property insurance for property securing loan delivered to Fannie Mae must have insurance, including the insurance covers endorsement, Let me see here, anything. No, including wind, fire, earthquake, flood, riot too. Okay. Smoke, hail, right? Make sure that your insurance cover that too, right? Because Mother Nature throw anything at you, you need to be able to have the insurance cover for that. Fannie Mae does not accept property insurance policy that limit or excludes from coverage in whole or in part, right? Including windstorm, hurricane, hail damages, or any other perils that may normally are included under an extended coverage endorsement. Some insurance, they only cover certain things. You probably have to pay some extended coverage as well. Okay, last slide. Prepayment requirement. Conventional do not allow prepayment penalty. So none of the conventional mortgage products allow prepayment penalties. Employment and income requirements, including 30 days pay stub, 2 years of W-2, 2 years of tax return if self-employed, an offer letter if not yet started, a proof of education for new graduates. So new graduate, right, you can go out and buy a house right away. As long as you have money to pay, you have a proof of graduation, right? And maybe you get an offer letter from an employer, okay? Not an offer letter to the seller, okay? Debt to income ratio is a factor too. To find your debt to income ratio, add up all your loan payments, including student loan, personal loan, car loan, credit card minimum payment, your projected mortgage payment. Add all that up, that's your debt to income ratio. That's your debt divided by the income that you get monthly. The debt also divided into monthly. Okay? Thank you. Am I on time? Woo, I got 3 minutes. Okay? A lot of good information. Right? So far we touched base with different kind of loan, conforming, non-conforming, traditional, non-traditional, jumbo, seller concessions, right? A lot of good information, good stuff. Anybody have any questions? I think I saw Darren came in late. Let me drop the file again here for you, Darren. Anybody have any question for me? Remember, we don't have class tomorrow, okay? But we do have class on Friday. Right, anybody have any question? Hopefully it's a good stuff. Anybody? Anyone? I talk a lot. I don't know how I have energy to talk the whole straight hour. Imagine when they have 3-hour class. I talk the whole time. Right? Sometimes I stop and ask questions too. Anybody have any questions? Hopefully it's interesting stuff. A lot of things I'm saying right now, right? I know it's gonna bury in your memory somewhere, right? When you study, make sure you watch my video again. Make sure you see my slide deck again. It's gonna bring back your, the thing that I'm teaching, I'm sharing. But guess what? When you get into the testing room, you're probably gonna remember what I say too. It's gonna be magically appear. Okay. Anything. Okay. If nothing, then I'll see you Friday. Okay. Have a good
Thank you.
day. Okay. Bye-bye, everyone.
Thank you.
Good night.
Good night.